Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on. Small caps are a tariff value trap. Here's why. Let's get into it.
The Russell 2000 is down nearly 11% from its highs, and everyone's calling it a buying opportunity. It's not. That 31% discount to the S&P 500 exists for structural reasons that tariffs are making worse.
That 31% discount is the widest in a decade. The last time the gap was this extreme, late 2022, the Russell 2000 rallied 28% over the following 12 months. You're confusing cheap with broken.
Or you're confusing cheap with a value trap. These companies have thin margins, floating rate debt, and zero pricing power. That's not a discount, that's a warning label.
Sure, but Wall Street's consensus is already priced in. Everyone hates small caps right now. When the fear is this unanimous, the trade is usually on the other side.
Sentiment is a terrible timing tool. You know what's not priced in? The margin compression that's coming. Small caps are disproportionately exposed to input cost inflation from tariffs because they can't absorb it the way large caps can.
But that ignores the reassuring tailwind. These tariffs are designed to bring manufacturing back to the US, and guess who benefits from domestic industrial build-out? Small domestic companies. That narrative is real and it's underpriced.
The reassuring narrative is massively overhyped. Building a factory takes 3 to 5 years. Tariffs can be reversed in a single executive order. You're betting on a long-term structural shift with a policy tool that could vanish overnight.
Even if you discount reassuring entirely, you still have the rate cut cycle. The Fed hasn't even started cutting yet. Small caps carry more floating rate debt, which means when rates come down, their interest expenses drop faster than anyone else's.
That's actually my point turned inside out. Floating rate debt is the silent killer right now. Rates are still elevated, and every quarter these companies are paying more in interest while their margins are getting squeezed by tariff-driven input costs. You're asking people to buy into pain today on the hope of rate cuts tomorrow.
I'm asking people to buy when the pain is at its maximum, which is exactly when you get the best entry points. The 17.7x multiple already reflects the pain. You're not paying for optimism here.
17.7x on what earnings, though? If margins compress another 2 or 3 points from tariff costs, those earnings estimates are coming down, and suddenly 17.7x becomes 20x or 22x on revised numbers. The multiple looks cheap until the denominator shrinks.
That's fair on the earnings risk, I'll give you that. But you're assuming no pricing power at all. Plenty of small caps serve niche domestic markets where they are the supplier. Not every small company is a commodity business getting squeezed.
Plenty is doing a lot of heavy lifting there. The median Russell 2000 company has operating margins in the single digits. When your starting margin is 7 or 8%, a tariff-driven input cost increase of even 3% is catastrophic. Large caps at 15% margins can absorb that. Small caps can't.
So be selective. I'm not saying buy the entire Russell 2000 blindly. The play is in domestically oriented small caps with pricing power and low leverage. They exist, and they're getting thrown out with the bathwater right now.
If you have to be that selective, you're not really making a small cap bull case anymore. You're making a stock picker's case, which is a completely different argument than buy the Russell 2000 because it's cheap.
That's how every great small cap cycle starts, though. The index looks ugly, smart money picks through the rubble, and 12 months later everyone wishes they'd been braver. Mean reversion is a force of nature in this part of the market.
Mean reversion assumes the structural conditions that created the historical mean still hold. They don't. The tariff regime is fundamentally different from anything we've had in recent decades. You can't just overlay a 2022 analogy onto 2026.
People said the same thing during COVID, during the trade war in 2018, during the taper tantrum. This time is different is the 4 most expensive words in investing. The discount always closes eventually.
Sometimes it closes by the expensive thing getting cheaper, not the cheap thing getting more expensive. If megacap multiples compress, your discount narrows without small caps gaining a cent.
That's a scenario, sure. But even in that world, you'd rather own the asset class trading at 17.7x than the one at 25.7x. If everything sells off, the cheaper starting point gives you less downside.
Not if the cheaper one has worse fundamentals, which it does. Lower margins, higher leverage, less pricing power. Valuation isn't a floor when the business quality is deteriorating.
We're going in circles. Let me put it simply, every data point you're citing, tariff exposure, floating rate debt, margin pressure, is consensus. It's on the front page of every financial outlet. Markets price consensus. The opportunity is in what happens when even one of those headwinds fades.
And my point is equally simple, consensus can be right. Sometimes the thing everyone is worried about is actually the thing that happens. Cheap can get cheaper when the fundamentals justify it.
Then let me leave you with this, the Russell 2000 at 2,438, with a decade-wide discount and a rate cut cycle ahead, is the kind of setup you look back on and wish you'd acted on. The fear is the feature, not the bug.
And I'll leave you with this, a 31% discount with compressing margins, rising input costs, and no pricing power isn't a buying opportunity. It's a value trap wearing a bargain sign, and the tariff regime is tightening the noose.
The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.